Personal consumption expenditure, Fed's preferred measure for tweaking interest rate, the headline figure increased 3.8%. It's a huge climb up from February at 2.8% and March at 3.5%. You can see at the chart at the right. Then when you look at the core figure, which basically removes food and energy prices, the gap is small. The core figure landed at 3.3%. This means that services prices have also gone up. But the soft month-on-month readings is providing some hope that prices have begun to ease a little. Hopefully this doesn't go too high, which forces Fed to increase interest rates. On to Eurozone. First, let's look at the nominal gross domestic product numbers at the left, the top four. The biggest one is Germany, then UK, France, then Italy, and Russia is at number 5. The nominal numbers don't consider costs of living. It's the surface-level whole figure. Now, when you adjust for varying price levels and living costs, you see Russia jumped from number 5 to number 1 at the picture on the right, and Germany is down to number 2. You can see the impact of inflation on European countries, and a lot of them are very sensitive to oil prices, except for Russia. For Germany this time around, their inflation dropped a little. While central banks cannot help with energy prices, governments can, at least temporarily. They can do it by reducing fuel and diesel taxes. May's headline, consumer inflation, dropped a little to 2.6%. The trend is at the chart at the right. For month to month, the figure dropped by 0.2%. It's the first drop since start of the year, and both core and services inflation are now back to levels before the war. This is because of the government's help in tackling higher energy prices. But this might not last for a long time. So, looking ahead, higher energy prices will still affect transportation costs, food prices, and industrial products. This will also lead to supply chain frictions. It's a bit of a domino effect. Let's look at France, the top 3 economy in Euro area. France is looking worse. The economic outlook is deteriorating very quickly, inflation went up higher again, and domestic demand is weakening. Recession is increasingly likely. For inflation in May, it's 2.4% because of high energy prices. Services inflation also picked up, now at 2%. The little bit of bright side is the likelihood of inflation shock to be like 2022 remains very limited. That's during the energy crisis following Russia's invasion of Ukraine, on top of existing post-COVID supply bottlenecks. The likelihood of that is low now because France's domestic demand is weak. Household and energy consumption's dropped. Consumer confidence is very low, the lowest since March 2023. Households are very pessimistic about their financial situation and willingness to purchase items weakened. The economy started at a weaker footing, and looking ahead, it's deteriorating further. Quarter one's growth already had a contraction. You can see it at the chart at the right. If the next quarter contracts again, they'll fall into a technical recession. This is a recap. We went through this on 27th May. Basically, this is saying that the high fuel prices impact disposable income, and so then the willingness to spend dropped sharply across Eurozone countries, specifically Germany, Austria, Italy, and Spain. Let's go on to Italy. Inflation wave continued in May because of high energy prices. Headline inflation is 3.2%. Non-regulated energy prices jumped 12.6%. The regulated one went up 5.8%. Both are not small figures. Now the good thing is core inflation, excluding energy and food, went up 1.8%. This is different from the US. The gap between headline and the core figure is larger. That means their biggest problem is energy prices and not services. So energy prices will obviously strongly depend on the reopening of Strait of Hormuz and how much the Italian government can help to fund the temporary tax cuts on fuel. Wage growth decelerated further, now at 2.4%, previously at 2.7%, and the likelihood of increment is not present. So businesses are not confident that they can pass through the newly incurred costs to consumers. That means their profits will be affected. And looking ahead, headline inflation is expected to continue to go up through the rest of this year. Now on to China, which is better. A quick recap. We went through this on May 29th. China's March industrial profit jumped a lot and landed at 15.8% year-on-year, mostly because of strong AI and semiconductor demand. Now in April, industrial profits jumped again, even higher at 24.7% year-on-year. It's the fastest growth since November 2023, and the trend is mostly the same. Computing and electronics equipment saw the largest profit jump, and oil and gas extractions also saw rise in profits. Automobile manufacturers in Q1 had a negative 17.7% in profits because of the price wars. There are so many automobile companies competing with each other, and everyone tries to sell theirs cheaper. But now, the drop improved to a dip of 16.8%. To conclude, the improvement in profitability is uneven. It's mostly concentrated in upstream and high-tech sectors. Other industries continue to struggle, but overall, it's still good news. Here's the latest one between US, Israel, and Iran. Iran said they'll stop negotiating and fully close Strait of Hormuz because of the ongoing violations in ceasefire and also Israel's military against Lebanon. And the oil prices jumped more than 7%. President Trump will talk to Israel's Prime Minister Benjamin Netanyahu. Singapore's Q1 economy grew 1% quarter-on-quarter, but if you compare Q1 this year against 2025, then the economy grew 6%. However, there's a bit of a slowdown in the quarter-on-quarter trend in the chart at the right. The Ministry of Trade and Industry still upgraded the GDP forecast to a range of 2 to 4%. Previously, it was 1 to 3%. But they also acknowledge the global economic backdrop has deteriorated. The key risks are the US, Israel, Iran, Strait of Hormuz problems, and Trump's renewed tariff escalation, if there's any. The good things are the two recent developments will remain resilient and are strong growth drivers for Singapore. Number 1, NVIDIA confirmed that they'll open a research hub in Singapore, focusing on embodied AI and infrastructure. And Singapore's safe haven status continues to attract capital inwards. And this time around, more from the Gulf countries. The 3 local banks, DBS, OCBC, and UOB, benefited in the wealth management sector. Manufacturing expanded 7.9% year-on-year. Electronics and precision engineering within this class were the primary growth drivers. The slowdown is mostly attributed to the previous high base at 11.4%. The good news is that sustained global AI capital expenditure will remain the key driver for manufacturing in Singapore. The ongoing demand for networking chips, memory chips, and semiconductor will remain robust. Wholesale trade grew 11.7% because of high demand in telecommunications, computer, and related components, reflecting the continued AI infrastructure demand globally. Finance and insurance sectors expanded at 5.7% year-on-year. The ones that will struggle are the energy-exposed sectors. They'll continue to face pressure. Disruptions linked to Strait of Hormuz affect prices of key input supplies like higher oil prices, fertilizer, and aluminium prices. Industries related to fuel, chemicals, and petrochemical will continue to face pressure. So, in conclusion, the AI-driven demand cycle will continue to support Singapore and will have a broad-based growth across manufacturing, wholesale trade, and tech services.